specifically developed for students who have gone through classes 1, 2, 3, or 4 of the Warrior Starter and are feeling overwhelmed. And I understand we're giving you a lot of information, and if you're new to the market, some of these concepts are already going to be unfamiliar. So I wanted to get this class started and offer this for you guys just to help everyone get onto the same page. So, if you need to go back and rewatch classes 1, 2, and 3, and 4 after watching this, that's fine. If you have questions that you want to ask in our mentor sessions for Warrior Pro students, that's okay as well. But hopefully this will be a good answer to a lot of questions that you have. All right, so let's see. Let me just pull up my my notes here. I'm going to get my pointer going as well. All right, so question number 1, how does the stock market work? And this is, again, I want to sort of start with basics. So the stock market, NYSE, New York Stock Exchange, was founded March 8th, 1817. And stock market exchanges are based on a country. So the United States, we have several exchanges. Canada, they have an exchange. Australia has an exchange. Germany has an exchange. London has an exchange. Japan, Tokyo has an exchange. And so we typically will trade stocks on, for us, we only trade stocks on the U.S. exchange. And typically, most traders, even if they're located in Europe or they're located in Asia, they trade stocks on the U.S. exchange, which is kind of interesting. So why do people choose the U.S. exchange? It's because it is the most popular stock market in the world, and it has the most volume, and it has many of the largest companies in the world listed on its exchanges. So, if you want to trade Apple, then you're going to be trading the U.S. exchange. Apple's an international, global company, but it trades on the U.S. exchange. So, and even some companies that are located in other places, like Alibaba, it trades on the U.S. exchange as well. So, for people that are located in different countries, you may, for whatever reason, decide that you'd prefer to trade on your local exchange. And that's okay, because all of the patterns and the strategies that I'm going to teach you can be applied to your local exchange. However, the broker that I use, the stockbroker, is specifically for U.S. stocks. A lot of the tools that I've developed, such as my stock scanners, are specifically for U.S. stocks. So you would have to find equivalents for your local exchange, an equivalent scanner, an equivalent broker, and a charting platform that would offer stock charts for stocks listed on your exchange. However, most students that are in our classes, even though we have students all around the world, choose to trade on the U.S. exchange. All right, now, if a company has authorized 100 million shares and it's already sold or assigned 50 million shares to insiders, such as founders and CEOs, what they could choose to do is they could sell the remaining 50 million shares to the general public through an initial public offering. So this is sort of answering the question of how do stocks come to be available to trade? How do companies list shares to sell? The reason that a company would list these shares is to raise money. So if this company, for instance, sells 50 million shares to the general public at an IPO price of $10 a share, they're going to raise $500 million by going public, which is huge. They can then use that capital in any way that they see fit based on their board of directors, whether they want to make investments, build out infrastructure, whatever it might be, acquire other companies. They now have a lot more working capital. However, they also have to answer to their shareholders in quarterly and annual financial reports. And if shareholders aren't seeing the desired growth rate, majority shareholders could petition the board of directors for a change, such as firing the CEO or changing the business models. So, these are things that certainly can weigh heavily on stocks or companies that are publicly traded. And there are many companies that will say that they never want to go public because they don't want to have to answer to those shareholders. And if they don't need to raise the money, then there isn't really a lot of purpose in going public. If they already have enough money to carry out operations and expand at their desired rate, then they might just stay a private company. All right. So now, when we are buying stocks, when we're trading or we're investing, we are actually buying small shares of a company. You are taking a fractional ownership in these companies. Now, if the price of shares increase, whether it's in minutes, hours, days, or years, you'll profit from the difference between your entry price and your eventual exit price. So, for example, if you enter a stock at $10 with 1,000 shares, and you exit at $15, your profit is $5 per share. The difference between 10 and 15 is 5. $5 per share profit times 1,000 shares is a $5,000 profit. That would obviously be a terrific trade. It's a 50% gain. Obviously, you cannot buy shares of every single company. As I said, lots of companies will not make shares available to trade. Right now, for instance, Geico is not a company that you can that's publicly traded. Uber is not a company that's publicly traded. So, those are companies that exist, but you can't buy shares of them. They haven't chosen to go public and be listed on the exchange. And so, we are limited in the trades that we take to obviously stocks that are listed, and I think there's about 15,000 stocks or 15,000 companies that have listed on the exchanges that we're trading. So there's a pretty big list to choose from, but certainly not every company is going to be available to trade. Now, something that is also interesting is of all of the companies that are available to trade, only a select few are actually going to be worth trading on any given day. And we choose those using the scanners that I've already shown you a little bit. That's how we find that needle in the haystack. So you may think, geez, 15,000 stocks, companies, this is crazy. How am I going to choose? We make that really easy. We have a simple system of narrowing it down, and we're immediately able to filter out all of them except for maybe 40 each day. And then from that list of 40, we narrow it down to 3 or 4 that are actually worth trading. So how do you buy shares of a company? Well, we have to go through an intermediary, and this intermediary is called our broker. So originally, we would have to use a licensed stockbroker who would go down to the exchange and execute your trades in person on the trading floor. And that's no longer the case. With a digital age, shares can be bought via your broker's online platform directly by you. And we all know this. So this right here is my trading platform, for instance. And I can buy shares right in here with the buy button and the sell button, and they go through instantaneously. So it's really incredible. Now, we still need the broker to act as that intermediary. They take our order and then they route the order to the market. And in exchange for that service, we pay them a commission, which I'll talk about a little bit more later. All right, so I want you to think of the market as kind of like an island. So this is the island here, and on the island we have people who are saying, I want to buy shares of this stock at X price. So let's just say, for instance, I'll just pull up the S&P 500. Let's say I want to buy 100 shares of the S&P 500, and I'm going to just put an order down really low. So it's currently trading at 259. I'll put an order at 257. I put the buy order there, and now that order is just sitting there. It's at the island right now, sitting as a buy order. So I'm one of those people saying, hey, I want to buy 100 shares of this stock at 57.08, and my order is going to sit there for a while because the current price is 59.87, right? So I'm not currently giving the best offer. The best offer is going to be right here on the top. This is currently the best offer of a buyer, and this is the best offer of someone willing to sell shares. All right. Now, regardless of which broker we use, every broker is sending your orders into this same island. So these little arrows here, this is like E-Trade and Ameritrade, and this is Lightspeed and Scottrade and TradeKing and whatever, Interactive Brokers. So these are just all different brokers, and there's a million different paths to get onto the island. And I'll talk about which brokers we would prefer to use, but I want you to sort of think of it as this island where everyone comes together. So the market for these stocks is occurring in one place. Now I'm going to cancel this order so I don't forget about it. All right, so now my order is canceled. All right, so if you're a buyer, you place orders saying, I want to buy stocks at a current price. Or if you're a seller, you place orders saying, I want to sell these shares at a current price. But remember, if you want to simply buy the shares, you can post your order on the bid. This is called the bid right here, the left side. You can post your order to buy, or you can always buy from someone who's selling. But when you buy from someone who's selling, you pay a slightly higher price. And that's the only difference. I actually am always buying from a seller on the ask, and that's totally okay. It's a fine way to do it. You just pay a little bit more. So the bid right here, the bid price is the current best buyer. The highest price buyer creates the best bid. And then the lowest price seller creates the best ask. And so on the left, we have all of our buyers, and all of their orders are lined up. So here you see these are buyers wanting to buy, this says 13 shares, but it's abbreviated, so it's actually 1,300. We add 2 zeros. So 1,300 shares at $2.16. This is someone who wants to buy another 1,300 shares at $2.16. Here's someone who wants to buy 1,100 shares at $2.16. Here's someone who wants to buy 1,000 shares at $2.16. Here's someone who wants to buy 300 shares at $2.16. So these are all people that have their order at the same price. So the way this works is whoever placed their order first will get filled first if someone comes and tries to sell them shares. So they're already in a little bit of a line. And then we've got people who are putting up orders to buy at $2.15, $2.15, $2.15. Now on this side, this is the ask. This is the lowest price of a seller. The lowest price someone is willing to sell this for is $2.17 and 700 shares. Now, if he tried to sell it for $2.16, he wouldn't be the lowest price seller because there's already a buyer that would take his shares immediately. If I press an order right now to sell at $2.16, I'm going to sell right to this guy. Likewise, if I press an order to buy at $2.17, I'm going to buy right from this guy. So this is a constant match of the current best buyer and the current best seller in terms of highest price buyer and lowest price seller. Now, there's always going to be a minimum of a 1 penny spread. The 1 penny is the difference between the best bid and the best seller. That means we'll see stocks trading at prices of a 10.01 by 10.02. If we look at back onto my actual trading platform, we'll see the S&P 500 is 259.87 by 259.88. Now, minimum is 1 cent. However, there's no maximum. So in this case, the best buyer on this stock is 9.35 and the best seller is 9.40. So we have a little bit of a bigger spread, and that can occur when there just simply isn't as much trading interest or volume in that stock. This stock has 5.5 million shares, whereas the S&P 500 has 11 million. And here's another one, ELTK. The best buyer right now is 624, and the best seller is 630. So if I want to get in this right now, I could press an order to buy these 1,200 shares at 630. Or if I say, well, I don't want to pay that high of a price, I'd rather get in at 625, I could place an order to buy at 625 right now, and I would show up right there on the bid. And just for the heck of it, I'll do it with 1 share. I don't think I'll get filled. All right. Looks like I probably would have gotten filled, so I won't do that. But in any case, you get the idea. If I place an order right now at 605, 606, I am going to be the best buyer. And currently, we've got a bigger spread. 605 by 630, that's a pretty big difference. So these types of situations, usually we wouldn't even really trade them because there's just too much risk. NXTD, in contrast, tighter spread, 137 by 138, so only 1 penny. And there's a few different things that count in or factor into a stock having a bigger spread, which we'll talk more about during the classes. So the spread is the difference between the bid price and the ask price. All right. Now, this is level 1, this is actually showing you level 2. Level 1 would be, let's see, if you only see, there we go. if you could only see this right here, that right there is level 1. And this actually shows you right here, this is called level 1, LV1. It's 216 by 217. So level 1 tells you simply the current price. It's the best bid and the best seller, the best ask. So it's 216 by 217. The problem is level 1 doesn't really give us a lot of information. All we see is the current price. That's all we see. When we're looking in contrast at level 2, now we're seeing the depth of market. And so level 2 is sometimes called depth of market because we see, okay, well, not only, the price is 216 by 217, but how many buyers are at 216? How many sellers are at 217? I want to see all of those people lined up. And this is just showing you a small section. If we look at the S&P 500, you can scroll down. I mean, you can see as long as you want. I can see on this all the way up to 280 at the very bottom of my second monitor. So, a stock like CLNT, you want to be able to see this. Now, I don't choose to show myself that much depth. I'm fine with just looking at the amount that you were able to see on my chart before, which is, which is this much. That's fine. I can see, 2, 4, 6, 8, 10 rows down, plus or minus. And that usually is sufficient to get a sense of what's happening in the market. Are there really, then notable, here's a 10,000 share buyer at 955. That's a larger order. So when we start to see larger orders, it can be indicative of there's some support here from a buyer. In contrast, if we saw a really big seller like 50,000 shares, we would think, there might be some resistance there from a seller. Now, this is getting into learning to read level 2. And learning to read level 2 is something that I teach you in the day trading class, the original day trading class, and it's pretty extensive. I mean, there's a lot that goes into really learning to read the subtle patterns here in the type of orders you see, where they're placed on the level 2. So we'll start by really having you understand just simply that level 2 exists, that it's the depth of the market, and we'll get into more detail on it later in the classes. Now, what we're really going to focus on primarily will be chart patterns, because if you're focused on the chart pattern, these nice clear patterns, then you're basing your entry on what you see here. Okay, so we've already talked a little bit about these flag patterns. So our entries would be right here at 38.49 and right here at 39.44. Those would be the 2 entry points. So if you're using just your chart, you're like, okay, I want to buy here, I want to buy here. When you then pull up the level 2 next to the chart, what if you're thinking about buying at 38.49 and you see a 200,000 share seller? Right now, that's going to start to educate you and make you think, maybe I don't want to buy this quite yet. So it's kind of like adding layers of skill. The first layer is understanding risk. The second layer is the right type of stocks to trade. The third layer is understanding these patterns. And the fourth layers would be understanding things like the level 2. So it gets, and once you understand all of these layers, you're going to have a tremendous amount of knowledge. And that knowledge is going to give you an edge over other traders. So, and it gives you an edge over the market in general, and that's how you become profitable. So, right now, I just want to make sure that we're all on the same page with sort of just the basic concepts of level 1 and level 2, what they are, and we'll leave it at that for right now. We'll come back to it. Now, when we're taking trades, there are different types of orders that we can place, and the 2 types of orders that we predominantly would be looking at would be market orders and limit orders. So, what's the difference between these 2 types of orders? Well, when you send a market order to the island, what you're doing is you're saying, if it's a buy order, you're saying, I want to buy shares, and I just want to buy them from the best current ask price, which would be considered the market price. So again, here on CLNT, if I place a market order, and under type, I can choose market. I choose market, I press buy, I'm going to be buying at this price right here because that's the best ask. However, there is some risk because if in the difference between when I press the buy button And when my order is received by the market, let's say someone else buys before me at 940, I might end up getting my shares at 944. Or maybe the stock drops and I get filled at 935. So there can be a little bit of a difference between the price that you think you're going to get and the price that you actually get. And that's why instead of using a market order, I like to use a limit order. With a limit order, I can say the most I'm willing to pay is this price of, let's say, 242. So if it does pop up to 244, now I'm not going to get my shares filled. I've said that this is the limit, this is the most I'm willing to pay. However, remember, now the prices come up. So my order at 942 is currently going to be one of the buyers. I may not be the best buyer if the price is 943 by 944, but I'm on the buy side. I'm on the bid. And if the stock drops back down, then my order might get filled. I will typically just simply cancel my order if I don't get filled immediately, rather than wait for the stock to drop and then pick up my order, because I get into stocks at breakout points, and that means if the stock drops, that's already a bad thing. I certainly don't want to be adding more shares because the stock is dropping. Now you can see here under this order type, there's other types that you can use, but we just use limit orders and market orders. This is what I use 100% of the time. It's just a simple limit order. A stop order, I guess, would be the third type of order, and a stop order, the way it works is, let's say I'm holding this stock at an average of 940. I put a stop order at 912. I press sell. When the price drops to 912, my stop order will fire and it will sell my shares to the market. Using a plain stop order is going to send my order as a market order. Using a stop limit will stop my order at the stop price, and then it sends a limit order, which would be the least I'm willing to accept for the stock. I don't do that because if I get stopped out, I just want to get filled. I don't want the risk that my order won't get filled. So the two types of orders we use for buying and selling are limit orders and market orders, and to stop out for a loss, we'll use a stop order. There are some traders who will use stop orders as triggers because this order as a stop will not fire until this stop price is triggered. So right now, let's say I actually want to buy the stock when it breaks 945. I could actually, instead of pressing sell, I could press buy, and as soon as the price crosses that level, then my order will get filled. But I personally don't like doing that because by the time the price comes up to 945, well, what if there's a 200,000 share seller at 950? Because if that's the case, then I'm actually not going to want to press the buy button. So I don't use that. I just really, for my trading, use standard limit orders and just regular stop orders for max loss. All right, let's push this back down here. All right, so when it comes to limit orders, we would consider a marketable limit order to be a limit order that the limit is above the current best price of the market. So, oh my gosh. I don't know why I'm having a hard time scrolling this. So, let's see. Every time I click on it, it's like it doesn't want to move. Oh my gosh. All right, let's go back. All right, so CLNT here. If I place an order at 972 as a limit order to buy, it's a marketable order because my max price is above the current best seller. It's higher than that. So I will get filled instantly. However, if I put an order, at 902, that's not marketable because the order will not get filled instantly, and so I'll have to wait for it to get filled. I'll have to wait for the price to drop. All right. So, are all brokers created equally? We use brokers as the intermediary to communicate to the market, and as active traders who are trading more than 10 times per month, we want brokers that offer faster execution speeds. So, the fast execution speed is the difference between when you press the send button and when you actually get the notification that your order is filled. typically that should be milliseconds. It should be almost instantaneous. However, with some brokers, it can be as much as a second, 2 seconds, 3 seconds, 5 seconds, or even 10 seconds, which is really an unacceptable level of latency and lag time. So we want fast executions. Now, there are a couple of different brokers that we use. I use Lightspeed Trading as my broker right now. I've been very happy with them. Fast executions and a stable platform. Other brokers that some of our students like would be Thinkorswim, TD Ameritrade, and E-Trade. And there may be another one that you like, such as Interactive Brokers, which is good as well. But you just want to make sure that the platform is stable, is fast, and those are probably the two most important things, and that the commissions are reasonable. Now, when it comes to commissions, there are two different types of commission structures. Some brokers charge a flat commission for each trade, such as $9.99. So every time you press the buy button or the sell button and you receive shares from the market, you will pay a commission. Now, remember when I placed that order for the S&P 500 down here, SPY, I will not pay any commission on this trade because I canceled it. I didn't get filled. So all of the ones that show 0, I don't pay commission on. I only pay commission on the orders that actually filled some of the position. Now, other brokers will charge you a per share commission structure for each trade, and this is a little bit different. So per share typically is 0.003. So in this case, 1,000 shares times 0.003 is $3 per trade, $3 per 1,000 shares. If you take 10,000 shares, it would be $30. So in fact, in this case, that would be more expensive than the flat rate of $10 in and $10 out. And then lastly, other brokers charge you a reduced flat commission rate, like $2 per trade, and a smaller per share commission, like 0.0015. This is very common. And so you kind of, in that way, get the best of both worlds. It's a reduced rate, but you are paying a slight per share commission. And that per share commission is charged basically to give you the ability to make this choice right here, to choose which, this is called a route, and this is to choose which route you're going to send your order to the market. Now, brokers that charge you a flat fee of like $10 per trade, they usually don't let you choose the market route. And the reason is because they've made an agreement with some other route, and they're actually getting paid to use that route. So that's kind of they're getting a special discount for using that route, and so they want to encourage your order flow to go just that path. And that's often not the path that would be the best for you as an active trader. So I would prefer to direct route all of my orders, and then if I end up having an order or a route that's going slow, I can change it to one of the others. I've got backups. If you're depending on just one single route because your broker doesn't give you the option, I consider that to be a single point of failure, and that's not a good thing. So most of the brokers that do this are the bigger ones like E-Trade and Ameritrade, and they don't give you a lot of choice on direct routing, or they don't give you any choice at all. And I think that's not an ideal situation, although it doesn't mean you can't be profitable and you can't trade there. We've got students at all of these brokers who are trading successfully, so it's really whatever you're used to. It's just something to be aware of. All right, now the PDT rule is something that will affect all traders in the United States. So the PDT rule states that we must maintain a minimum of a $25,000 balance in order to day trade daily. And I know when I got started, this was a real shock to me because I was like, I don't have $25,000 in my account. Well, there's a couple workarounds. Now, the first is traders unable to maintain that minimum balance can only day trade 3 times a week, which is obviously not ideal. The solution, well, here's one. Some traders like to use SureTrader, which is a broker located in the Bahamas. They have higher commissions, about twice as high as any other broker, but their minimum account size is only $500, and you can day trade as much as you want. So some traders like to use them. Number 2 is swing trading, because when you're holding overnight, you're not day trading, and so that's, of course, fine. And number 3 is options trading. Now, the nice thing with options trades is that the trade settles overnight. So if you have a $1,000 account and you do a $1,000 options trade, you could do one trade every day because the next morning that cash is ready in your account to trade again. So those are the three sort of workarounds to the PDT rule that a lot of traders will use. Now in 2017, when I funded my $583 account with SureTrader, I was trading with SureTrader, and I traded there until I broke over 25,000, and then I moved my money back to a U.S. firm where my commissions were 50% lower. So, it was a situation where, to me, it made sense to pay the higher commission for a short period of time while I built up my account and then move my account back into a broker in the U.S. Now, for all of you guys, you're beginner traders, and the fact that you're watching this video tells me that, you're really kind of very beginner even to the market. So I would say you shouldn't be trading with real money for at least 3 months. You should be trading in the simulator, practicing, and so I wouldn't worry too much about the PDT rule. Once you get to the point where your metrics are looking good, then we can look at, okay, what's the best path here? Is it short trader, is it swing trading, or is it options trading? Now, a question that a lot of students will ask me, especially beginner traders, is what is short selling? Now, 99% of my trades include buying shares with the goal of selling them for a higher price and for a profit. However, some traders choose to do the exact opposite. They sell shares at a high price and then buy them back at a lower price. So how does this work? How are you allowed to sell something before you buy it? Well, our brokers actually allow us to borrow shares that they already own and sell them. Now, basically, it's like your friend lending you his lawnmower, and you go and sell it for $300. But now you still owe your friend a lawnmower. So you go on Craigslist, you buy back the same lawnmower for $150. You find one that's cheaper. You give it back to your neighbor. He doesn't know the difference, and you just pocketed the difference, which is $150. And that's the way it is when you short. You sell shares at a high price. You now make a profit, but you have to buy them back. And you have a limited time to buy them back, which is usually between 14 days and like 3 weeks. So you have to buy those shares back. You have to give them back to the broker, and you hope to be able to give them back at a lower price. Here's the reason that I don't like to short. Number one, if the stock goes from $2 to $100 and you shorted it, you could have to buy back at $100 per share. So imagine you short 2,000 shares at $2 per share. That's $4,000. That's $4,000 of value that you shorted. So you made $4,000. It goes up to $100 per share, and you have to cover it at 100. That's going to be $200,000. That means you just lost $196,000 on that trade, even though you only started with $4,000. That's unacceptable to me. Now, obviously, no one should hold a stock while it goes up and up and up, but the reality is this will happen to beginner traders, deer in the headlights type of scenario. And we see stocks all the time that make these explosive moves. And just to, really hammer the point home, look at Roku from $20 to $48. Look at CHFS on this day back here from $3 to $24. If you were shorting this at $3 or $4 and not covering it, you could have lost tens of thousands of dollars, even hundreds of thousands of dollars. Now, so the first reason I don't like to short is because I don't think it's a good strategy for beginner traders. The second reason that I don't like to short is because you cannot short in a 401k or IRA account. So if you're trading in your retirement accounts, which a lot of our students are, you simply wouldn't be able to short at all. So I don't like trading a strategy that excludes a large number of traders in our community. So I focus on trading to the long side, but you should be aware that short selling is an option if you choose to use it. Mike, he does actually trade quite a bit to the short side, so you'll see that in the chat room. Now, here's a question. What is a stock chart? Well, the stock chart is simply a visual display of price over a period of time. And what's interesting is that over hundreds of years of stock market trading, familiar patterns have been seen in stock charts that are used to predict future price. So when stocks begin to show these well-known patterns, traders will buy shares anticipating that the stock is going to move higher. And that's what we do every single day. Whether you're trading stocks, cryptocurrency, Forex, or futures, these patterns are universal. And that's what's really, really cool. Now, the fundamentals of a company include things like their cash flow, their earnings per share, their sector, their products, their debt. And this type of information can potentially help us make predictions in price over the course of, 3 to 6 months, 6 to 12 months, or 2 to 3 years. But it doesn't really help us make any prediction of what this stock is going to do in the next 20 minutes. And that's what we're doing as day traders. What is this stock going to do in the next 20 minutes? So we focus on the technicals of a company. And the technicals are charts. That's what they are. So these familiar chart patterns often result in spikes in buying volume, and those create short-term opportunities. Now, even though we're only trading for 20, 30 minutes at a time, by trading with larger positions, we can take advantage of small intraday movements in price to the point where we can make $300, $400, $500 a day, or for me on my best day, over $40,000 in a single day. Now, in order to be a trader, you need to learn to read charts because, being an investor, maybe you don't worry about charts that much. You're focused on the fundamentals. But as a trader, we're focused on these small changes in price. We need charts. And we cover charts in depth in our classes. And we encourage you to use good charting software, whether it's the software included in our trading simulator or software included by a third-party provider. So this here is eSignal. It's about $150 a month. And this here on the other side, or right there, is TC2000. This is like $40 a month. I definitely encourage you guys to use TC2000 because it's cheaper. All right. Now, let me just push this back here. So the most common technical indicators that traders use are volume bars and moving averages. So the volume bars are these bars right here, and these are displaying the total amount of volume that took place during this candlestick period. And remember, a candlestick is, again, a visual representation of price telling us 4 pieces of information. A candlestick tells us the open price, the close price of that period, the high of that period, and the low of that period. So the high is the top of the wick. The low is the bottom of the wick down here. For a green candle, the open is the bottom of the body and the close is the top of the body. For a red candle, the open is the top and the close is the bottom because the price went down. All right, so the volume bar tells us how much volume occurred during that period. And it shows you right here in green, volume 600, it shows you the actual number of shares that were traded. Now, in addition to these volume bars, which are important, we use moving averages. And moving averages simply show us, a simple moving average, the average price of the stock over a certain number of periods. The most common moving averages are the 9, this is the 9 right here, the 9, the 20, and the 200. Now, the 9 moving average tells us the average price over the last 9 candlesticks. So the length is 9. Now, watch what happens if I change the length to 21. It starts to go lower. If I change the length to 200, it goes even lower. If I change the length to 500, it goes even lower because the average price over the last 250 candlesticks is lower because the stock has moved up so quickly. So we're just simply looking at the average price over the last 9 candlesticks, the last 20 candlesticks, and the last 200. Now what's interesting is that there are 2 types of moving averages. You've got simple and you have exponential. I use exponential moving averages, and I do that because an exponential moving average uses a formula to weight recent price action heavily. So what that means is that if a stock moves quickly, the moving average is going to move fast with it because the price of the last couple of candles is more important than the price of the candles 18 or 19 candlesticks away. So it basically is like a fast moving and fast reacting moving average. And this is good for day trading. The last indicator that I didn't put on here, but that is popular, is the volume weighted average price. And I'll bring this back up for you. Oh my goodness, I'm having problems with this again. Okay. That's this dotted line here. this is interesting because this is the average price over the last, it's actually over the entire day. But what it does is it adds the number of shares that traded at each price. So it's not just the average price, it's the average price including the volume, the amount of shares traded. So this is actually the average price of the stock over the entire day. The exact average price. This is the exact equilibrium point. And so we often see stocks when they come up to their average price, if they're below it, they can break through it and then break back down below it. A lot of times a really strong stock, and I'll show you an example here, when they break through that price, the average price, traders who at one point might have been short decide to cover their position and get out because it's showing strength when it breaks through the average price. Look at that break through the average price from $5 up to $6, $7, $8, $9, $10 per share. That's a crazy move. All right, so we'll move that back down. So now I'll show you how to get your charts set up in 1 second, but let's go over one other thing first. A question that a lot of traders will ask, what's the difference between outstanding shares, float, and volume? All right, outstanding shares are the total number of shares issued by the company, and many of those shares are held by insiders and are thus unavailable to trade. Float refers to the number of shares available to trade. So it's the portion of the outstanding shares minus those held by insiders. So float is a smaller number than the number of outstanding shares. And last is volume, and this is the number of shares traded each day when we're looking at a daily chart, or the number of shares traded each minute if we're looking at a minute chart, or 5 minutes if we're looking at a 5-minute chart. Now, another question is, what is a gap? So a gap is something that occurs when a stock opens higher than it closed the previous day. So let's look at this stock, for instance. Here we have on the chart this big gap. This is a gap. I'm going to get rid of these two lines here. Boom, boom. Oops. There we go. All right, so I'm going to close this. So a gap is this space right here. This was the close. Yesterday, the stock closed at $4.64, and today it actually opened all the way up here. The open price was $11.46, which is crazy. So that was the gap. Now, at this point, the stock is starting to drop down, and it's what we would call filling the gap. It's coming back in. It currently has still an open gap right in this space. So why would a stock open higher than it closes the previous day? And the reason is because there's an imbalance between buyers and sellers. The next morning, there are so many people wanting to buy the stock that the demand is higher and the price is higher. So this is usually the result of news. And there was news on this stock today. So some type of news, whether it's earnings, FDA announcements, it could be a million different things, but it's generally the result of news. Now, here's another question. What is a stock split or a reverse stock split? This is a question that students sometimes ask. So a company trading at high prices can conduct a stock split. So stock A, the price is $700 per share. Let's just first say, for example. And they say, look, this isn't fair that our price is $700 a share because it makes it really hard for new investors with small accounts to buy our stock. So we need to do a stock split, make our stock more affordable to sort of intermediate investors. Let's do a 7-to-1 stock split. The next morning, the stock opens at $100 per share. Did it drop 80%? No, it didn't. If you were holding 1,000 shares at $700 per share, that was $700,000 of value. The next morning, you now own 7,000 shares at $100 per share, which is still $700,000 of value. Now, before a stock split, the company will announce this weeks, months, sometimes ahead of time, so it's well known that this is going to happen. That's a traditional stock split. A reverse stock split goes the other way. So stock B is priced at 10 cents. Now, you should know that they are not compliant with the exchanges to be priced below $1. So they can be below $1 for a period of time, but eventually the exchange will send them a notice and say, hey, you need to get your price back up above $1 or we're going to delist you. So they do a 1 to 10 reverse stock split. The next morning, the stock opens at $1 per share. Did it go up 100%? No. If you held 1,000 shares the previous day at 10 cents, which is 1,000, or what is that? That's $100 of total value. You now, the next day, own 100 shares at $1, which is still $100 of total value. There's no change in your value. It's just a change in the price. However, what is interesting is that these changes affect the number of shares that are outstanding and the float. Because if you do a 7-to-1 traditional split, well, the number of shares just multiplied by 7, right? So if you had 50 million shares that were outstanding, now you have 350 million, right? Whereas down here, if you had 1 million shares outstanding, or let's say you had 10 million shares outstanding, after the reverse split, you only have 1 million shares. So the float is getting lower. Now, we see this a lot with small cap, low price stocks, reverse split. And so they can continue to do it again and again and again. And here's a company, let's just show you as an example, that has done many reverse splits. All of these green S's are reverse split. Reverse split, reverse split. So basically the stock goes down, they do a reverse split, it goes down again. They do another reverse split, it goes down again, another. So when we scroll this back, look at how bad this chart is. It's crazy bad. Like, it just goes lower and lower and lower and lower. So, and then whatever. We see this with small cap stocks fairly often, that they're below $1, they need to do a reverse split, and they do it. The next day the stock is at $1, and if that's the only change, then and the company is still weak and still has problems, then the stock is probably just going to keep going down. All right, so now when it comes to setting up your charts, this is TC2000, and when you open it, it usually looks something like this. Now, you can right-click on the back here, and you can make some changes like edit chart properties. And I could change the back of the gradient to different colors if I wanted to, make it a gradient. Some people like to be a little fancy with their charts. That's fine. I'm just going to leave mine at black. For pre and post market data, you can say always on, or you can say never on. I like to always have it on because I like to see what the stock did pre-market and after hours. If we edit chart properties, you can change the price style from candlesticks to a line chart if you wanted to. No one would ever use this for day trading, but you could. You can make it a bar chart. Again, no one would use this for day trading. Everyone uses candlestick charts. Color based on open versus close is what we want. We don't want to do it based on net change. We always do it based on open versus close. So see how this candle turns is green? That's because the open price was here and the close price was here. The net change versus the previous day was obviously red. But this is not an accurate depiction to me. The candle in this case should be green. Should be green based on the open versus the close change. So we leave that like that. If we want to add a technical indicator, we can right click and say add plot, and then we type in moving average, and here we go. Exponential moving average. It's going to ask me what I want to apply it to. I want to apply it to the price, which is the stock. I could also have gone here and said add plot here, and then say moving average, and again, would have done it the same way. Then you can select the one you're looking at, edit, and change the color. And, change to 75 or 85, make it whatever you want. You can adjust the opacity of it, make it a little bit not as bold, stuff like that. So for me, and I'll just remove this one, my charts are very simple. Yes, when I go to plot, these are all of the indicators you could use. Don't worry about them. They're not going to help you be a better trader. Just keep it simple. We're going to focus on the chart patterns, and we're going to focus on the volume. We're not going to worry about any of this other stuff. All right, so we like to keep it really simple. That's always worked best for me. So I use the 9, the 200, and the 20, and the 20 I usually have in blue. The 200, and I don't use the 50 on this chart. So this is what it looks like for me. That's what all my charts look like. All right, now to do the same thing over in eSignal, if you wanted to over there, it's still pretty much, it's slightly different. All of these platforms are a little bit different. You can right click here, and you can, let's see, this is called insert a study. What you can also do is double click on an indicator like a moving average, and you'll see your chart manager here of the current ones that are active. You can check them to take them off or put them back on, and you can press the plus button to add a new one. So start typing moving average. There you go. You can apply it, close. You can change from simple to exponential, change the time, change the length, change the color, and then you're good to go. So pretty simple there, getting that set up. Again, I keep my background in black. I go down to time template and I change this to 24 hours because I want to be able to see the pre-market chart like this. I can also click on properties and make changes here for the background color, session breaks, stuff like that. You can see the session break is right here. I'm pointing at the chart. You guys can't see that, but it's the pre-market after hours line right there. Again, during the course, we're going to have demos of all of these platforms that go into even more detail, but I just want to kind of walk you through a couple of these things in case you're already feeling a little unsure about them. All right, so I'll drag that down there, and I'll drag this down here as well. All right, so how do we find stocks to trade? A lot of people say, gosh, there's 15,000 stocks on the market. Finding stocks to trade is going to be impossible. This is overwhelming. Well, it's actually incredibly easy. We find stocks with our stock scanners, and we know what patterns we're looking for. I know that I'm looking for these little pullback patterns. I've trained my scanners to look for stocks that either are forming those patterns or that have a good likelihood of forming those patterns because they have really high volume. I'm going to walk you through that as part of Class 8 of the Day Trade course. Mike is going to walk you through the scanners that he uses. Jeff will talk about the swing trading and option scanners. So all of that is coming soon. But for right now, the best way is to be in the chat room. And each morning, you'll see me looking at my gap scanner. The gap scanner is the list of stocks that are opening higher today than they closed yesterday. And remember, stocks only open higher than they closed yesterday because of news. So we like the gap scanner because it's giving us a good indication of stocks that will potentially have a lot of volatility today and could move up very quickly. Here's a stock right on our scanners at 360 that moved up all the way to a high of 1396. That's crazy. That's a huge move. I made $22,000. Oh, sorry, $31,000 on that stock. It was ridiculous. Now, a question that students will also ask is, how do I determine my profit targets? So in order to determine profit targets, we first have to understand our risk. Now, in Chapter 2, I explained profit-loss ratios. Maybe you haven't seen that yet, but you will see it soon if you haven't already. The profit-loss ratio is your average winner versus your average loser. As day traders, we focus on a 2-to-1 profit-loss ratio, which means we're willing to risk $100 to make $200. For most traders, I would say a realistic profit would be 20 to 40 cents per share of profit. So for instance, we buy a stock at $2, and for this one, let's set a 20-cent target. So the profit target's 20 cents, the max loss is 10 cents. That's a 2-to-1 profit-loss ratio. Now, I could set my stop at 95 and set my target at 210, and that's still a 2-to-1 profit-loss ratio. So as tight as I can get the stop, I'm going to set it. I want to have my losses as small as possible. And so there are times where you'll see me sell for 5 cents or 8 cents or 10 cents profit, and it's usually because I had a very, very tight stop. For a higher price stock, we might buy at $35.50 with a max loss of $35.30 and a profit target of $35.90. So kind of bigger range here to accommodate the higher amount of range that we see on these types of stocks. But again, we're going to talk more about this later in the class, but if you're buying breakout patterns, you're buying stocks that are breaking out, that are squeezing higher out of that pullback pattern, getting 10, 20, 30 cents is usually very realistic. Getting 30, 40, 50 is occasional. Getting 80 cents to $1 per share is every now and then, not every day, but back of your mind potential. So setting profit targets between 20 and 40 cents is often fine. If you're really focusing on the lower price stocks with me, you may end up getting into more of the 5 to 15 cent kind of narrower range of profit, but that's fine. You can make a lot of money with 5 to 15 cent moves if your share size is a little bit larger. Now, I also want to remind you guys the break-even points when you lose money. If you lose 10% on a trade, it needs to now go up 11.1% for you to break even. If you lose 20% on a trade, it now needs to go up 25% for you to break even. If you lose 30% on a trade, it now needs to go up 42% to break even. If you lose 40% on a trade, it needs to go up 66% to break even. If you lose 50%, you buy a stock at $10 and it drops to $5. For it to go from 5 back to 10 is doubling. It needs to go up 100%. You lose 60%, you need to go up 150%, and you lose 75%, you need to go up 300% to get back to break even. So let's keep really tight stops. It just makes it easier. It makes it so much easier to recover from the losses. And this is what every investor and every trader knows. And even the big investors like Warren Buffett and Carl Icahn, they know that in order to be successful long term, they have to keep their stops and their max loss as tight as possible. So another question is, what is trading, swing trading, or investing? Well, trading is typically considered buying and selling shares within minutes or hours. Whether you're trading cryptocurrency, stocks, day trading stocks, Forex, or futures, trading is very active. Swing trading is considered buying and selling and holding for 2 to 3 days, sometimes 4 or 5 days, sometimes a week, but a fairly short period of time. A short-term investment is considered anything less than 1 year long, so it's several months long usually. And a long-term investment is considered anything more than 1 year. And we don't really do that very much for the type of trading that we do. Now, the best times to day trade are in the morning from 9:30 to 11:30 Eastern Time. This is when the market has the most trading volume. Traders that aren't able to trade during those periods of the day often will look to swing trading or options trading or maybe some short-term investing. Here's a question. Can I trade from an app on my phone? And the answer here is yes and no. You can trade from an app, but it would be very difficult to day trade from an app because you simply won't have all the information you need. You won't have all the charts. You won't have the level 2. You're not going to have the news. You're just going to be limited on the tools that you have, and it would make it very hard. You need an edge to be a successful day trader, and you can't really get that from an app. So if you're restricted to trading on an app, you should be swing trading, not day trading. How to read your account screens in your trading account. This is a question that a lot of traders will ask, and you'll notice this in trading simulators and stuff like that. So most account screens will show you your positions window. And your positions window tells you, well, when you open the day, it has nothing there unless you're still holding a stock from the previous day, but it shows you the symbol, the position. Mine shows me the price of my last order, my last execution. It shows me my open profit and it shows me my closed profit. Now, since all of my trades are zero, I don't have any open profit. I only have closed profit or a loss. And that's fine. If I was still holding 100 shares, then I would have some open profit or loss on a trade. If I scroll over, I can see this column is duplicated. Don't worry about that. This shows me my number of trades today. This shows me the number of shares where I removed liquidity and the number of shares where I added liquidity. Don't worry about this when you're trading the simulator. It's not relevant. We'll talk about it in, I think, Chapter 10 and 11 of the day trading course. Down here on my window, I have active orders. Now, some people have active and executed and canceled orders all in the same place. I like to have them in 2 different places because if I have an order for, the SPY, whatever, that I put the 100 share order there, I don't want to forget about it. And if it's somewhere buried in all of my executed orders, I might forget it's there. I might close down the computer and then, I get filled the next day or later that afternoon. So in here, I can go into the settings and I can change the type of orders that I'm looking at. And this for me is my active orders, and this is all of my executed orders and my canceled orders. So it shows me the price, the time, symbol, price, the quantity. It shows me that I bought or that I sold. Down here are messages from my broker, little system messages. Down there is an account summary. So this is fairly standard across most accounts. Displays can be a little bit different, but these are the types of things that you look at. Up here is my total profit. This is my total equity, the amount of cash that's in my account as of this morning, and this is my total buying power. Now, when I'm looking at a level 2 window, I can see obviously the level 2. A few of the things that I see up here, this shows 25%, and that means that I can use my margin on it. All this buying power I can use. This stock says 100%, which means I can't use any borrowed money. I can only use capital, my cash. I have to use 100% cash on this stock. This E tells me that this is an easy to borrow stock. The L here, here, and here says I have to locate it, and it's going to be hard to locate. CB refers to a stock that's dropped more than 10% in one day. NXTD, I didn't realize that it had actually done that, but I guess it did on this drop here. It dropped from 145 down to 125. So it dropped 10% off the highs, and CB is turned on. All right, so that's a quick little walkthrough there of your account and just level 2. All right, let's click on this. There we go. Okay, so and a reminder on the tech requirements to trade. So it will be hard for you to day trade from an app, so you will need a computer. I would say one that's not older than 3 years old, a minimum of 8 gigabytes of RAM, and preferably a 256 gigabyte solid state hard drive. That would be what I would prefer to see you using. I like to have 3 total monitors. For me, that can be my laptop screen and 2 external monitors. Or if I'm using a desktop, I would just have at least 2 monitors, but probably 3. In this setup that I have right now, I have actually 9 monitors, but that's overkill. You don't need that many if you're just trading. I'm trading, I'm doing these videos, I'm doing the chat room, I've got a million things going on. So for me, I've built it out a little bit. But for you, the laptop with 2 external monitors, you'll be good to go. All right, so I hope that this has been a really helpful class and that I've been able to kind of get you up to speed on some of the things you weren't sure about. I want to also give you the link here to our, and I'm sure you are already aware of this, but just give you a link to the day trading terminology page. Let's see, right here, and encourage you, if you have just terms that you're unfamiliar with, to type them in here. You can access terminology from our homepage, and you can get your answers to simple questions there. Students that are in the Warrior Pro course, you're welcome to ask us questions during our Tuesday, Wednesday, Thursday mentor sessions. Students in the Warrior Starter course, once you finish the Starter, if you graduate to the Pro, you'll be able to ask us questions there, and in the meantime, you can send us emails. All right, everybody, so I'll let you get back to studying, and if you have any questions, don't hesitate to reach out. All right, I'll see you soon. Hey everyone. All right, so this is our back to basics. It's hours because I want to be able to see the pre-market chart. So for me, and I'll just remove this one, my charts are very simple. Yes, when I go to plot, these are all of the indicators you could use. Don't worry about them. They're not going to help you be a better trader. Just keep it simple. We're going to focus on the chart patterns and we're going to focus on the volume. We're not going to worry about any of this other stuff. All right, so we like to keep it really simple. That's always worked best for me. So I use the 9, the 200, and the 20, and the 20 I usually have in blue. The 200, and I don't use the 50 now and then. Buying in day trader computer and to use, or if I'm using a desktop, I would just have at least 2 monitors, but probably 3. In this setup that I have right now, I have actually 9 monitors, but that's overkill. You don't need that many if you're just trading. I'm trading, I'm doing these videos, I'm doing the chat room, I've got a million things going on. So for me, I've built it out a little bit. But for you, the laptop with 2 external monitors, you'll be good to go. All right, so I hope that this has been a really helpful class and that I've been able to kind of get you up to speed on some of the things you weren't sure about. I want to also give you the link here to our, and I'm sure you are already aware of this, but just give you a link to the day trading terminology page. Let's see, right here, and encourage you, if you have just terms that you're unfamiliar with, to type them in here. You can access terminology from our homepage, and you can get your answers to simple questions there. Students that are in the Warrior Pro course, you're welcome to ask us questions during our Tuesday, Wednesday, Thursday mentor sessions. Students in the Warrior Starter course, once you finish the Starter, if you graduate to the Pro, you'll be able to ask us questions there, and in the meantime, you can send us emails. All right, everybody, so I'll let you get back to studying, and if you have any questions, don't hesitate to reach out. All right, I'll see you soon.